Well, it definitely is the end of an era. I think it is sort of like the end of this phase of big tech where you had this, unfettered growth, where these business models were largely unassailable and they, were really just fighting to grow into their valuation and just generate more revenue to justify where they traded at. And now it's this next phase where they have to operate more like a cash cow business. And so, it's an acknowledgement that the growth is tapering. It's an acknowledgement that they're going to trade on a pretty tight band in terms of multiple, which means that they have to manage expenses much more tightly, which means that they can't have a really broad-based surface area in which to operate an experiment. You have to keep the experiments small. You have to manage your expenses. You can't have employees basically, run over the place. Management has to have a firm hand in dictating strategy and what people work on. So I think all of that signals that Jason, I don't think this is the end. I actually think it's the beginning, because these companies, Apple, Facebook, Google, maybe a little bit Microsoft, are the most sensitive to valuation because they are the most widely held, right? These are the equivalent of US Treasuries in the equity markets, the safest, most predictable safe haven in times of stress. If you want to own big, chunky cash flow generating businesses that, are relatively unassailable, you couldn't pick 4 better businesses than those. And so the fact that they see enough in the horizon to say that we need to batten down the hatches should be a warning to everybody else. My prediction now is that I think the markets are bottoming and consolidating. And this is the time, I think, to start nibbling and start getting ready to really rip the money in. And I think there's enough signals every day that kind of like tell me at least that on the margin, it's time, because I think the markets do a reasonably good job of digesting news and then pricing the forward reality, right? Like today's price is really everything we already know. And so the real guess is what's about to happen in the future. And from my perspective, I'm actually starting to get a little constructive here. I think that when companies like Facebook really do this, and like if you think about it one way, the financial markets have always had this thing that we have called a Fed put. What does that mean? A put is essentially the right to sell something. And what market participants have always known for the last decade is that if things got very hairy, if there was uncertainty in the market, the Federal Reserve would, and they have, consistently stepped in to create a buyer of last resort. And so it always eliminated that last part of true, supply-demand balance, because they would just come and say, don't worry. In many ways in tech, what the big tech companies were that. You could never really find what the true market clearing price for an engineer was, or what the true amount of expenses you should spend on office space or, free services. Because you always had these companies, which was an escalating arms race. If one company had a massage, the next company had gyms and massage and physical therapists, and the other company would have buses to take you to the gyms and massage and therapists, and the next company would have protein shakes that were freshly made. And it just kept escalating and escalating because the costs didn't matter. And they wanted, if nothing else, to get that marginal engineer or product manager or business person to work at their company, which eliminated the risk that they would actually start something to disrupt them.
Blocker strategy is very real. You should unpack
the blocker strategies is very real. So when you take this big tech put out of the market, you will get true price discovery, and you will find out what the real price should be for this kind of an engineer, that kind of a product manager. You'll find out what are the real expenses you need to bear in order to build a real lasting business? And you'll be able to sort through all of that stuff out. So I think it's a really good moment. And again, it's yet another indication to me that I think broadly speaking, the markets are now starting to stabilize. All the irrational behavior is starting to exit the system. The party is in the last few hours. Volume's going down, the alcohol is being taken away. People are hanging around with a little bit, lights are coming on. They're like, oh, I've been here a little too long. And I think that that's a very healthy process for an economy. And I think that that's what's happening right now. So I'm constructive. I'm a little bullish. I'll go out on a limb. I think, we could be 3 to 5% from the lows, but we're more near the lows than the highs.
is sleepwalking.
I do not want Amazon, okay, to control my vacuum cleaner. I'm just going to put that on the record, okay? Because what happens if
they know where the dirt is? They know which rooms are dirty.
What happens if they get a hold of Roomba? I'll tell you what happens. The next thing is they're going to go after Dyson, okay? And then once they do that, they're going to put chips in these things, and all of a sudden they're going to know exactly what Jason said. What are you eating?
Where your dust bunnies are.
Overwhelmingly, I think where the problem stands is a central bank that was the same through both of those administrations. And I think we should probably focus on them because you're right. What they did was excessive. And what they essentially said is that if there is volatility beyond a certain amount and people cry uncle, we will not allow the markets to sort themselves out in an orderly way. We will step in. And that's what, again, what we just talked about, the central bank put. In this case, the Fed
interventions, yeah.
And these interventions really pervert a market because you don't know what's going on. And that has huge ramifications in the real economy. So, Nick, if you could just throw up this chart. The thing that is really important here, and what this chart shows, is essentially all of the hiking cycles that we've gone through since 1983. So 83, 87, 94, 99, 04, 15, and the current one. And here's what I just want to call out for you guys. What's incredible is that other than the one in 83, so this is sort of like, that last big one, what we've seen is that the stock market has a tendency to immediately go to the conclusion very early on in a rate hiking cycle. And now, why is that important for normal folks listening to this thing? Well, the reason why that's important is right now we're in month 7 of a cycle. We obviously don't know how long it's going to be, but the odds are improving every day that we're near the end versus the beginning. And why that's important is, again, if you're thinking about when to, buy equities, for example, this is a really instructive guide because what it tells you is the closer we get to the end, or more importantly, the closer we psychologically know that the end is coming, we start buying. And that's just a broad-based statement that has been true. So, what you see right now, I think, is really interesting, which is that despite all the bad information, oh my gosh, the Nord Stream pipeline blew up. Could it have been sabotage? Was it the CIA? Was it the Russians? Oh my gosh, big tech is slowing spending and firing people.
China's in a coup. I don't know if you saw that rumor. Yeah.
How about something more benign? The US, US yuan is really trading in a crazy way. The US euro is trading in a crazy way. The US pound is going crazy. Yeah. Despite all of that, every time we trade down, the market consolidates very quickly. And we sort of so I think we're forming a bottom. I do think that Stan is right. We are going to see a hard landing recession. Something will break in 2023. I hope it doesn't. I hope it doesn't affect a lot of normal people, but it's likely. But at the same time,
what do we define hard landing as?
So I'll tell you in a second. But at the same time, I think what's happening is in the equity and financial markets, we are consolidating a bottom because we're seeing through to that end state. And this is where cheap equity gets bought. So why is there a reason to sell now? I think a lot of the people that are selling, the smart money sellers that I talk to, are essentially right now selling to book in capital losses to offset other capital gains from this year, a term that's called tax loss harvesting. And so if you have gains through this year, which some of us do, this is the great moment to just sell the losers, to book the loss, to net it out so that you can minimize your taxes for next year. That's probably, I think, where we are at. And I think that's why there's still consolidated buying. So what is the hard landing, Jason? If I had to predict, I think what David said is absolutely right. You're going to see unemployment get to an awkward and uncomfortable number. 5-6%, I think, could be something that we see. And I think you're going to see a lot more companies pull way back on their spend because demand is going to really modulate. I'll give you a crazy example. What happens to all the people in the United States that are on ARM mortgages, right? Adjustable rate mortgages. When those things reset, they're going to reset 200-300 basis points higher. Their monthly payments are going to go nuclear.
Oh, it's already happened, Chamath. I literally had a family member call me about this, and they were like, "What do I do?"
So in the UK, 40% of all